Hi, everyone. Welcome and thank you for tuning into our National Bank Investment Podcast Series, the first of 2023. I'm your host, Martin Lefebvre, Chief Investment Officer at National Bank. Today, we're kicking things off with a bang with one of the most successful investment strategists of 2022, our guest, Candice Banks of Fiera Capital. Candice is a Vice President and Portfolio Manager, Global Asset Allocation. She's a member of the Asset Allocation Committee, focusing on central banks and fundamental macro analysis, and actively participates in the development and communication of the firm's asset allocation strategy. Candice has more than 15 years in the investment industry, including several years as an investment research analyst for a global investment management firm. Candice, thank you for joining us today.
Thanks so much for having me.
Candice, Montreal's investment community is a small world, as you know, and we've known each other for a few years now, but not many people can guess what brought a girl from the prairies to embrace finance in the first place and move to Montreal. So before we start, could you tell us a bit about your background and career, and then describe to us a little regarding the Global Asset Allocation Committee at Fiera Capital? Basically, we want to know what goes on behind the scene.
All right, sounds good. So, as you mentioned, I am from Western Canada, born and raised in small town Saskatchewan. But my career began in Calgary. I was working at Franklin Templeton Investments, doing a lot of the same macro analysis, global asset allocation for the retail Quotential program up until about 2010. From there, I moved over to a private wealth firm in Calgary called Canadian Wealth Management, where I was also managing some equity portfolios, Canadian and US, as well as doing asset allocation there as well. And then we were acquired by Fiera in 2012. So that's really the Montreal connection. A couple years after that, I joined the global asset allocation team here in Montreal. That was 2014. So, it's been a number of years now and having a great time. When it comes to the asset allocation team, our role, as you can imagine, is really just to position portfolios, both from a private wealth perspective as well as our institutional balanced accounts, positioning around our clients' long-term strategic objectives and targets to best capitalize on our expectations for financial markets on a tactical 12 to 18 month basis. So we're really positioning between cash, stocks, and bonds. And the process really hinges on two key pillars, and you'll hear me talking a lot about these throughout our conversation today. And that is really the global economy and central bank policy. And the reason we focus so much on these two pillars of our investment process is that when we're trying to decide how to be positioned between cash, bonds, stocks, we're ultimately looking for the next recession, which is obviously coincides with a bear market. And what is typically driving a recession is a central bank tightening event. So that's why we really spend a lot of time on those two factors in deciding how we want to be positioned, whether it's risk on or risk off. So I'll talk a little bit about that later when we get into the strategy.
Yeah, so my understanding is that the Asset Allocation Committee focuses a lot on macro analysis. You've mentioned inflation, central banks, and the risk of recessions. And we all know that how challenging 2022 was. And as I mentioned earlier, you've made some great market calls last year. So could you take us back to some of the key events that occurred in 2022 and how you were able to foresee some of them and position accordingly?
Yeah, so well, right out of the gate in 2022, the key highlight was inflation. We're coming out of the pandemic. We had all of this stimulus fueled pent up demand running up against very little in the way of supply. We were dealing with supply chain disruption stemming from the pandemic. China was still closed down. This was, of course, amplified by the war in Ukraine in March of last year, February, March. So all this together created this perfect storm for inflation, where you had all of this demand running up against very little in the way of supply or goods. And this, of course, created some significant inflationary pressures early on last year, and then, of course, prompted a very aggressive response from central banks. And the end result, as we all know, was an extremely volatile year and an extremely historic and unprecedented year for both stock and bond markets. Seeing negative double-digit returns for stocks and bonds in the same year, really something we haven't seen in several decades, for that matter.
Yeah, absolutely. I mean, you guys have been positioned underweight, bonds for so many years. It must have been some form of relief to see yields go up that much, although there's always a client at the end. That's
Yeah,
yeah,
it was long overdue. But at the same time, remember when policymakers, adopted this average inflation targeting, they wanted to overshoot inflation for a significant amount of time after undershooting the target for so many years.
yeah.
Well, of course, they got what they wished for and more, and it's created, of course, a lot of, worry and volatility in the financial markets.
They were certainly successful at doing that.
Yeah, yes, they were.
How do you feel the investors are reacting and all of that? What's how these events have shaped the environment for investors, do you think?
Yeah, so well, I think first and foremost, what 2022 showed us was that the traditional 60/40, equity bond portfolio is not meeting the objectives and needs of clients. And we've been talking about this for a number of years at Fiera, the need to diversify into private market strategies, strategies that are, less, less correlated to public market asset classes, the need for stability, the need for yield. All of this, really came to light in 2022, and the extremely volatile market environment for bonds and stocks just underscored the merits of diversifying a portfolio into the private market space in search for those attributes that were needed in the year like 2022, like stability, income, and yield. So I think that was really the key lesson for investors, and we've definitely noticed more investors willing to move into those asset classes because, as you can imagine, in years previous, when the MSCI All Country World is hitting a new record every day and bond markets are generating positive returns, clients are saying, "Well, I don't need private markets. Why would I move?" But it
Yeah.
really takes, an event like 2022, like I said, unprecedented numbers to really reinforce the case for the asset class.
Yeah, but now that yields have moved up, do you feel like the 60/40 is not back in vogue?
No, I mean, regrettably, our outlook for 2023 isn't that much better than it was for 2022. Like I said, well, 2022 was all about inflation and the aggressive response from central banks. We think that 2023 is going to be about the implications of that tightening and the implications for the global economy. And here, there's a couple things. Obviously, we're approaching, if not already in restrictive territory. This is going to eventually weigh on economic growth and throw the economy into some sort of recession. The magnitude is still unknown. The debate is between shallow, deep recession,
Hmm.
but also on the fixed income front, we're not convinced that central bankers are done. There's been a lot of excitement the last few weeks, even in December, about cooling inflation and this allowing central bankers to pivot, pause, maybe even cut rates by the end of this year. We think these expectations are completely misplaced. And if anything, central bankers have to do more. Because
Okay.
if you look at the details in the inflation reports that we've seen, all of the deceleration has been in goods. Well, that's not a big surprise. Commodity prices have come off. Supply chains are now correcting following the pandemic. Used car prices, new car prices, you can see those are coming down. But where we're
Yep.
not seeing any progress is on the services
Services
front.
and stuff
And
like
this
that.
is
Yeah.
what central bankers are really focused on and where they have control.
So I guess the bit of a market reversal that we're seeing right now, you don't think that's sustainable, and clearly there's more downside. I last time I checked, I guess your forecast was pretty on the pessimistic side. You still in that camp?
Yeah, we're of the view that this latest rally in both stock and bond markets is a bit of a head fake. And like I said, it's based on these expectations for central banks to pause early and even start cutting rates by the end of this year. Our sense is that, like I said, central banks need to do more. This is going to have a more profound impact on the economy. They essentially have to inflict more damage on the economy in order to bring, to cool off the labor market and to remedy those imbalances in the labor market as well that are keeping wages elevated and keeping services inflation elevated. So we think that's going to necessitate some pretty significant economic deterioration in order to bring inflation down to levels that they'd be more comfortable with. So that taken together, long story short, suggests that we still see more negative returns for stocks and bonds heading into this year.
So, how do you think investors should prepare for that?
So obviously, remaining defensive is very important in our view. We have a very sizable overweight allocation to cash right now. We're underweight stocks, underweight bonds, like I said, overweight cash, and we do have an overweight allocation to private markets as well. Again, just looking for that stability in the portfolio setting and what we think could be another erratic 2023.
Yeah, absolutely. But it seems to me that central banks are, starting at least foot is in the door that they're opening, for maybe pausing. Certainly in Canada, the Bank of Canada said that, and the market is expecting the Fed to raise rates another one, maybe two. Where do you see the risk in that scenario?
Yeah, so, the message that we're hearing from central banks is that they're downshifting the pace of rate hikes. So they're not doing the 75 basis points anymore. They're not doing
Hmm.
50, likely going down to 25 basis point increments. But they're also reinforcing that their work is not yet done. And you're hearing that in Europe, you're hearing that in the United States. I don't believe the Bank of Canada is done either. You look at the Business Outlook survey earlier this week, inflation expectations are still pretty elevated, both in the short and the long term. And I think, again, the tight labor market in Canada, wages still elevated. I think the bank is going to have to do more. But like you said, there is, some expectation for a pause in the near term. And, when the Fed gets to 5.25, when the Bank of Canada gets to 4.75, 5, yeah, they'll take a step back, look at the environment. But ultimately, we think that inflation will not be at levels that they'll be comfortable with in the next few months, and that will require them to move further and move higher and stay there for longer. Because again, that's something again that I think the market is underestimating. That while eventually they'll pause, they're not going to start cutting rates right away. And we've heard directly from several Fed officials that have said rates need to stay there for longer and through the year.
Yeah, Candice, we see that equities are certainly not cheap. Perhaps a little cheaper in Canada, but in the US, price earning ratios are hovering around 17, 18,
Yeah.
right on the historical norm. And they're certainly not cheap. Do you see any opportunities? I mean, there's a lot of bad news out there, a lot of uncertainty, but still at minus 25% at some point in time in 2022, there was all of these sort of bad news were already priced in, or lots of them were already priced in. So, do you see any opportunities in today's market?
Yeah, so a couple things. First of all, I think you're right. Valuations in the US are too expensive, particularly given the environment that we're in. And we've seen valuations get more expensive, obviously, in the last few months as financial conditions have eased in response to these expectations that rates will eventually come back down. So we've seen some PE expansion. Like you said, PEs, I think, sitting around 17.5 times in the US. The last time rates were going to 5%, the PE was at around 15. So we think that, again, that move is overdone and that you could see some PE contraction in particularly in the US, given that it's a little bit more expensive there. And when it comes to what's priced in, so last year, the declines in equity markets were all PE driven. So PEs came down across the board in response to higher interest rates, tighter financial conditions. There was very little in the way of adjustment for earnings.
Hmm.
If anything, earnings were revised higher. And right now, analysts are still very optimistic on the earnings outlook, predicting mid-single digit growth in the next 12 months.
Why is
That
that,
doesn't
do you think?
that doesn't reflect the economic reality. And we think that's why earnings are vulnerable to downgrades, because in a typical recession, earnings contraction is anywhere from 15 to 25%, depending on the depth of the recession. So again, that's where we think there's a little bit of, it's overdone on the earnings front. Analysts are too optimistic, and we think that earnings are ripe for downgrades and are going to drive the next down leg in this equity market. And that's really why we are, so pessimistic, is because that has not yet been factored into the equation when it comes to stocks. It's all been PE driven, interest rate driven, very little recognition for a deteriorating economy and accordingly earnings outlook.
So last year, I guess cash was, the place to be, especially U.S. dollar cash for Canadian investors. What asset class will outperform this year?
This year, we've got cash outperforming. We've got cash generating around 5% in the coming year, and our expectations versus negative returns in both stocks and
bonds.
And bonds. Yes.
Oh, really?
Yeah.
Okay.
Yeah. I mean, we see interest rates going, Fed funds peaking at 6%. That's probably the highest on the street. I haven't heard a lot of other, research firms or analysts predicting something that hawkish. So we're a bit out of consensus on that aspect. And then, of course, that means a steeper recession and, of course, earnings recession. So that's why we're so negative on stocks and bonds in the coming year.
Yeah, but some analysts will tell you that the higher they go with interest rates, the tougher the recession will be, and that's got to be discounted in the in longer term rates, right?
Oh, I wouldn't say it's discounted in longer term rates as of yet because, there's no compensation there for inflation. Let's not forget that central banks are shrinking their balance sheets. This has not yet been reflected in long term yields. So, where are we at today? The Canadian 10-year is below 3, the US 10-year 3.5. I think this is too low given where we think short rates are going. That's going to ultimately put upward pressure on the long end as well. But it's these other factors that have not yet been accounted for or priced in the fixed income markets that we think will result in further upside pressure in bond yields this year.
Okay, let's shift to the inflationary pressures that you were mentioning. We know that there's probably going to be deflation in goods prices and energy prices and whatnot, commodities. But what about services? Where do you see labor scarcity and all of that playing in all of that?
Yeah, like I mentioned earlier, it's just these significant imbalances that we have in the market. It's the same thing in the US and Canada, where you have a shortage of workers, again, coming up against a lot of demand. In the US, that famous job openings ratio, there's 1.7 open positions per unemployed. So there's a lot of demand for workers right now and very little supply. So, of course, that's putting upward pressure on wages. So the key wage gauges in the US, for example, are all hovering around 5% right now, which again is much too high. And that's what's keeping services inflation so elevated. And you see that when you're out at restaurants or, in the retail space, there's just there's a lot less people helping out because there's a lot of demand, for workers. And of course, that's inevitably going to put some upward pressure on wages as people try to get people to come back into the workforce because participation isn't yet back to pre-pandemic levels either. A lot of people, I think, left the workforce permanently, but not everybody has come back either. So again, it's just these imbalances that we're seeing in the labor market that are really worrying for us because inevitably, like I said, central bankers, the only control they have is over the labor market and by using interest rates to soften the economy and soften conditions and bring those imbalances back into balance. They can't control what happens in Ukraine. They can't control what's going on in China. China's reopening now, which is great. But what if, they get some major outbreaks and factories start closing again? That starts putting upward pressure on prices. There's just a lot of uncertainty on that goods side of the equation. So the trends have been encouraging. That's great. But we're more worried about the more sticky, wage inflation, services inflation that central bankers are ultimately focused on, in getting back to their 2% objective.
And you don't see the tight labor market softening the blow in terms of recession. You still foresee a more traditional two, consecutive quarter of negative growth happening when 2023, early 2024. Yep. What you calling that?
Yeah, I think the tight labor market actually reinforces the need to be more aggressive for central bankers in order to bring inflation down. And that means that the recession scenario that we foresee will take hold likely in the second quarter. And it'll be quick. If it's this deep recession scenario that we're talking about, it'll be Q2, Q3, maybe Q3, Q4, depending on when they start pushing rates higher, as we expect. But it'll be quick. I think the longer they delay bringing inflation under control, of course, you hear about the stagflation risk. The longer they wait, and if they choose to live with higher inflation, that's just going to prolong the damage, and it's going to extend into 2024. If they move now, get inflation under control, it'll be a deep recession, but it'll be shorter in duration.
Well, Candice, time flies by. It was very interesting. I hope our listener liked it as much as I did. Thank you very much for joining in today, and thanks everyone for tuning into this MBI podcast. We'll talk to you soon, probably in the course of the month of February. Thank you very much.
Thank you.